Hey, everybody, and welcome. Thank you so much for joining us. My name is Rob Phelan, also known as the FI Educator Online, and I'm going to be joined live by Jeremy Schneider today, who is the founder of Personal Finance Club. Really awesome social media account to follow, great blog, YouTube channel that goes with it as well. Whenever I get asked by teens, who should I be following online? Personal Finance Club is one of my first recommendations for accounts to follow for great information that is teen appropriate and helps people just get started in a really easy to understand way. Jeremy is joining us today to talk about investing. So I asked Jeremy, what topic do you want to talk about? He's like, investing 101, busting myths about it. Let's help people get started. I'm like, perfect. That's exactly what we need. So Jeremy, how are you doing today?
Great, Rob. How are you doing?
I'm doing awesome. It's good to see you. It's good to hear you. And we're going to bust some myths today about investing. So first off, for anyone who doesn't know who you are, you're a multi-millionaire at this point. Didn't start that way, weren't born that way. So how did you get there?
Yeah, I had a typical middle-class upbringing. I guess it's all typical from your perspective, but yeah, my parents weren't wealthy or anything. We were middle class. We were doing fine. I went to college. I got a degree in computer science, which I graduated in 2003, which was a good time, and still a very good time, by the way, to study computer science. And then I got a job offer from Microsoft. I turned down that job offer and instead decided to start my own company. I had no idea what I was doing. I lived on credit cards for a couple of years, but then over the course of 10 years, I started to do better and better. And then about 11 years later, in 2015, I sold the company for about $2 million, or I sold it for $5 million. My share after taxes was about $2 million. And then I basically have been investing that $2 million since then. And now it's 2022. So I was about 7.5 years ago. And now that 2 million has turned into about 4.5 million, which is my current net worth, which makes me, like you said, a multi-millionaire. How nice.
It must be very nice. Yeah, I can imagine it's quite nice. I'll let you know when I get there. But so there's like a whole side of this conversation we could go down, which is sort of that investing in yourself and starting your own business. It's not what we're here to talk about today, even though I think that would be such a cool conversation to have with you. One of my students did want to know, why did you choose to start a business and not go down the safer, more secure route, though, of a job? You're guaranteed an income, you're guaranteed a salary, you can plan for that, you can budget for it. So we've talked about that a lot as a personal finance class, that when your income is predictable, it becomes easier to budget versus when you have unpredictable income, it gets a little bit harder. Why did you choose to back yourself and go down the business route?
The main reason is that I just didn't want to. I had worked for Microsoft for 2 summers as an intern, and I didn't like being a cog in the machine. I didn't like having my work have relatively little correlation to my personal success. I feel like at a massive company, you can kill yourself 100 hours a week, or you can just kind of phone it in and do the minimum. And there's kind of like a slow difference in your return. Whereas with your own company, if you kill yourself and work 100 hours a week, you get like 1,000 times better return because it all comes back to you. And so, yeah, it was just, I didn't really like working for a huge company. Microsoft's a great company. I have no ill will towards them. I think it's great for anyone who wants to work there. Also, what's the other reason? Didn't like working for someone. Oh yeah, the other reason is that I could do that. I think a lot of people think entrepreneurs, or there's like this myth that entrepreneurs are like especially risk tolerant and can take these big risks. But really, I just had that opportunity because I wasn't a single mom of 3 kids. I had my parents help with the cost of college. I got track scholarships. I taught and worked throughout college. And so I basically had no student loans when I graduated. I even had a surplus of about $6,000. And so I could just do something ridiculous like starting a company at 22 years old. And so, yeah, between being fortunate and just not wanting the Microsoft job, if things had gone differently, I would have taken that job and paid off my student loans and maybe started a company later. But that's just the path I took.
We're seeing kind of a similar theme amongst a lot of the speakers who've been coming on, that Vincent Puglisi talked about this last week, creating financial freedom for yourself. It doesn't start when you have $1 million. It starts by having a surplus of income versus your costs, and having no debt or getting rid of your debt or keeping it super low is just one way to keep it easier to cover all of these expenses and allow you to take on some of these risks that come with maybe starting a business. Because part of your story, I think, is also how little you were able to live on in California, which is one of the most expensive states in the US to live in, probably one of the most expensive places in the world to live. You kept that super low, despite the fact that you were making quite a bit of money. Like, why'd you do that? And how did that help you achieve this sort of millionaire status?
Yeah, I mean, when I give the 10-second overview of my life, it's like, oh, this dude sold a company for millions of dollars. Now he's rich, must be easy. But the 11 years I was growing the company, my take-home salary was $36,000 a year. That was the most I ever paid myself. I was the lowest paid employee in my company. We never got any sort of venture capital or loans or anything like that. I was just like this young kid trying to start a company selling stuff and spending less than we made. And so out of somewhat necessity, I was living extremely frugally. Living in Southern California on $3,000 a month. Like my rent was like 700. I drove a 99 Ford Explorer that I bought in cash, so I had no car payment. Those are your two big expenses, housing and transportation. Then I didn't eat out much, just went to the grocery store. And, it wasn't bad. I think sometimes people just associate low spending with like sadness, and it wasn't sad. It was great. I was like by the beach and hung out with friends and played volleyball, and I just wasn't spending $200 on dinner. I would just go to the grocery store and eat at home or whatever. So yeah, that was kind of out of necessity. And then I wasn't really wealthy until I sold the company. Up until the day I sold my company, I was the lowest paid employee in my company and just kind of scraping by.
But keeping your costs low, and this is something that's really important for all of you that are in high school, you're maybe about to graduate. You have gotten very used to whatever the conditions are in your home. So your parents, grandparents, guardians, whoever it is, have created this home situation that you live in, which has not been an overnight thing. It's been years in accumulation. Their incomes have grown over time, hopefully. And one of the biggest traps that a lot of young people fall into is they graduate high school, they either go straight into the working world or they go into college and they live like a college student for a while. But as soon as they graduate and they're on their own with their first adult salary, they try and replicate the conditions that they had in their home before they left. And that's a big trap because you don't have the same income, you don't have the same life experience, you haven't spent the years building it up, and you can't just immediately go back to that level of living right away. Otherwise, you're going to totally eat up your entire salary. You will become paycheck to paycheck, and you'll struggle to create this gap for investing that I think Jeremy and I are going to talk a lot about today. So the word for this is lifestyle inflation. So don't inflate your lifestyle immediately. Try and keep it super frugal, super cheap for those first couple of years, and see, can you create that income that is going to allow you to just really turn on this investing machine that we're going to talk about. All right. So Jeremy, let's get into investing. And for those of you who are watching, if you have questions along the way, please use the Q&A feature of this call. So if you're in a classroom with a teacher, you should be able to submit questions on their behalf. If you're watching on your own, type it in the bottom, and we will have a Q&A section towards the end of the call where we'll try and answer your questions if we haven't talked about it already. So kicking things off, when we talk about investing, what are you talking about?
Investing is when you buy something that is likely to go up in value and pays you while you own it. And I think it's really important to like meet both of those standards, because in my opinion, there's this big difference between what you hear about as investing often in the news and stuff, which is really speculating, and what's really investing. Speculating is guessing. It's like buying crypto or Dogecoin or GameStop, or guessing if inflation is going to go up or down, or guessing which stock to buy, or guessing, it's all this it's like this gambling guessing game of speculation. And I think the news reports on this speculation because it's interesting, like what happened today in the market, what happened today with the crypto, what happened today with options or futures or whatever, but it's all just guessing and it gets so much attention. But investing is something that's much simpler, much slower, but much more likely to build wealth, which is just buying something, holding it, letting it produce income for you while you own it, and then having it likely go up in value over time. And so, for example, if you bought the house next to where you live and then you try to sell it 2 weeks later, you're just speculating. You're like, oh, maybe 2 weeks from now, the price of the home will go up. But if you buy that house with a plan to hold it for 10 years and you have renters move in and pay you rent, just for owning it, just for sitting there being an owner, collecting rent, you're going to get that rent for 10 years. And then 10 years from now, home prices are very likely to go up because they're not making more land and inflation and yada, yada, yada. And so by being an investor, by owning that home, you're going to make a lot of money in that home, right? And so investing is qualifies for those two things: likely to go up in value, pays you while you own it. And so stocks generally meet that as long as you're owning them for long periods of time, because they pay dividends and they're likely to go up in value. In real estate, those are the two basic ways that I invest: stocks and real estate. All the other stuff, all the guessing, all the day trading, all the jumping in and out, the short-term stuff, that's all just speculation. I don't even consider investing.
Okay, so the key thing there, everyone, is that you're expecting your money to increase in value over time. And I think for a true investment as well, it has to increase in value more than inflation is decreasing the value of your money. So like putting your money in a savings account isn't really investing, even though it is growing in value. Like there might be some interest attached to it, but we know, especially when inflation is high, it's eating away at the value of that money. It's not really growing over time. So we need something that is going to be worth more in the future, ideally more than inflation is decreasing the value of it. And this is something that not everyone throws in. You want it to make money for you during the time that you're holding as well. So not just sell it later for more. We want it to make money right now. So this might rule out something like a collectible where you're like, okay, I want to buy rare Pokemon cards, hold them for 10 years, sell them in the future, and I'll make more then. And that's when I'll make my money. You want it to make money for you during that holding period, which is a really cool thing if you can find those investments that do that. All right. So we misuse the word investment a lot, I think. Like I've heard my mom, myself, my wife have all said this at some point in time. Like, I'm buying this thing, it's on sale right now. It's a real investment because it's going to save me money over the long term. And it might save you money, but it's not an investment. Is there anything else where you like, we misuse the word investment?
Yeah, I agree with that. I mean, this gets kind of more into like the world of English, and some words have multiple meanings. And that's one of those words. It's like, yeah, it's an investment in a clean house. It's an investment in my sanity or whatever. But in terms of a financial investment, I think, all of that stuff is just spending money, and maybe it's good spending money. Maybe it's a frugal choice. Maybe it's a good purchase. Maybe it's a value, but just still spending money. Investment, I think, just has to meet those two qualities of likely to go up in value, pay you as long as you own it. That's what a real investment is. Yeah. And then also all the speculation stuff, I don't consider investment. I think those are the two big ones that I hear that I'm like, that's not investing, that's speculating or spending.
What about education? Is education an investment?
You could make an argument that it is. Like if you pay for college, you're buying something that is going to pay you as long as you have it, which is your degree, because you're going to be making more money. You can't sell it, so it's not really like in the same sense. But I guess I take less of an issue with like the investing in myself terminology there. It certainly is like a wise use of money. I think most degrees today still make great financial sense. You're much more likely to out earn the cost of those degrees by many factors. So I think it's a good decision. And yeah, I don't really take an issue with investing in yourself. You're maybe worth more later, but you never sell yourself. I don't know.
I bring it up definitely because I saw a post that you actually put out today where you were showing different degrees, and you're like, the credit from the university is the exact same, so the cost per credit, but the expected salary you get from these different degrees is vastly different. And when you start thinking about your degree that way, it does start sounding a little bit more like an investment. Like you're going to put money in with the expectation that you will get more out in the future through increased earning potential.
Yeah.
Like you said, you can't really turn that degree into cash at the very end. Like there's no way to cash in on this thing, but it does pay you more as you own it. So as you own this degree, it does pay out more typically.
Yeah.
So definitely, yeah, education, consider it. That return on investment, which we talk about with owning any sort of investment, is something you really want to think about. How much will I get out versus what I put in? And does it make sense or not? Is this actually an investment, or is it really just costing me money? All right. Today's focus is busting myths around investing. And I wrote down a couple that I could think of. I'm sure you've got some as well. I'm going to let you go first though. What is a reason that people will throw out there for not investing that's a total myth, and we can just bust this thing right now?
The stock market is gambling. The stock market is risky. And I think that goes back to the speculation versus investing perspective, right? So if you're just randomly buying stocks and selling stocks every day, then yeah, it is gambling. It is risky. But if you were buying all of the stocks in the entire stock market, which sounds crazy, but there's a very simple way to do that called an index fund. So if you buy an index fund and hold it for many, many years, it basically dilutes away all the risk. And so we hear there's kind of these like two competing narratives in pop culture. One is that the stock market is risky, and the other is that corporations are continuing to have record profits, and it's like corporations, those big corporations are always profiting, but the stock market's super risky. Well, the stock market owns the corporations. All those corporations you hear that are profiting are owned by the stock market. So when you buy stocks, you own them, and over a short period of time, there's speculation built into it. People are guessing, oh, is the market going to go down in a week? Is the market going to go up? And so you see that like daily news ticker, Dow Jones is down $200 today. But long term, none of that matters. Long term, all those growth and profits and innovation and hiring and revenues and products and sales, all the company is doing are funneled back to the stock market and back to the owners. And so you weather the short-term volatility, and then you get the long-term gain. And so one of the best analogies I've heard is it's not like a yo-yo. The stock market's not like a yo-yo going up and down. It's like a yo-yo while you're walking up a set of stairs. And so over any short period of time, it might feel like this bouncy situation, but as you ascend up the stairs, 10 years from now, the low is going to be way higher than the high that we experienced in January, right? And so right now the market's down, 15 or 20% this year, which is a bad year, but in 10 years, it's not going to matter. And so, yeah, it's only risky short-term, not long-term.
Yeah, I think someone once told me that when you buy an index fund, and just if anyone's not familiar with an index fund is a group of stocks. So a company will buy a little bit of every company in the US, for example. It's called a total US stock market index fund. And then you can buy a piece of that fund. So almost like a stock of the index fund. So by doing that, you now own a little bit of every company in that index fund. And there are index funds for things like the total US stock market, the international index. So it's everything outside of the US. You can own an emerging markets one. So that's new countries that are coming up with their stock markets and really starting to grow and develop. You can buy pharmaceutical ones, gaming ones, technology, construction. Like there's index funds for literally everything you can think of. Somebody at some point has grouped together stocks that are in that area, and you can buy a slice of that. And it's a great way to buy a lot of different things with one small investment. So like, for example, you can take $10 and put it into a US stock market, and it will subdivide that $10 across all of those different companies. And you now own a little piece of all of those. And the story that I was coming back to is someone told me, like, you are basically investing in hundreds of millions of people who are all working really, really hard to make that company more profitable than it was last year, because everyone is interested in making this company more valuable than it was last year. So you're essentially investing in people who are working really hard to try and be better than they were last year. Your money is inevitably going to go up over time. And if the entire market went to zero, we've got much bigger problems in the world than your money right now. So yeah, it's not a 100% thing, but it's as close as you're going to get to it, that over time, the US stock market has done nothing but go up over long stretches of time. I think you can't find a 30-year period in the US stock market history where it hasn't gone up over that 30 years.
There's not even, I don't think, a 15-year period. There's the occasional 10-year period where like the bottom of the very top of one peak corresponds to like the very bottom of the next crash or whatever. And so there's like a very brief 10-year moment in this 10-year period that happened from 2000 to 2010, basically, where 2000 was the peak of the dot-com boom, and 2010 was like kind of the bottom of the financial crisis. And so like when you kind of cherry pick that exact 10-year period, and to be fair, if you put in like $10,000 on that one day, and then you looked at it 10 years later, you'd see like $9,800, which seems terrible, but that's not really how people invest. They invest incrementally. And so if you invested consistently over that 10-year period, you would not only have saved a bunch of money, but you actually have way more than you put in, even though that was one of those lost decades. And then of course, if you extend out another 10 years, it would be up like, 5x or something. So your 10,000 turns into 50,000 over 20 years.
Okay, so that first myth, stocks are gambling. It can be. So just to summarize, it can be if you are picking individual stocks, you're picking single companies, and you're like, I'm going to buy this one, and I'm going to roll the dice that this will be worth more in 20, 30 years or tomorrow, depending on how you want to do it. So day trading is the act of buying and selling stocks either multiple times a day or once a day, or just a short term where you're trying to buy it and hopefully sell it for more in a short period of time later. Okay, that one, busted. I'm going to throw one out now. It takes money to make money. You need to have a lot of money to get started with investing. You can't do this when you're broke, or you can't do this on a low income. What do you say to that?
To some degree, it's true. You can't start with zero, but you don't need to be a millionaire to start. one of my favorite stats is that there is no 40-year period of the stock market where $250 a month turns into less than $1 million. And so, if you're listening to this and you're in high school, you might be like 250 is a lot, but you could get a job as a waiter or something, make, 50 or $100 a night, 2 or 3 nights a week, you made, $1,000 a month. You put $250 of that into the stock market, over 40 years, you're a millionaire. And so if you're listening to this and you're like high school age, 40 years, it sounds old, which is another myth that I might mention, but that's like, less than a normal career timeline, and then you're a millionaire. And so, and now actually we're kind of living in the golden age of investing in the US, where fees are very, very low. Back in like the 70s or something, if you wanted to invest, you would need to hire a stockbroker. They would charge a lot of money. It was kind of a rich person's game, where you would need tens of thousands of dollars to even have that conversation to make it worth someone's while to be purchasing and trading these stocks for you. But today you can go on apps. There's like one like Betterment, where it's like you put in $10, and like you said, with your $10, you own thousands of US stocks. And for sure, $10 alone won't make you rich. The more you put in, the more you get back. But getting started is very, very easy. And there's no real, high cost to getting started with these like low fee brokerages. So it's a really great time to be investing in the US.
Yeah. And even in the last 5 years, we've seen apps like Robinhood, Webull, these apps that have come out and have forced other brokerages and stocks to come down in fees, because they were just making it free. So Robinhood was one of the leaders in this area. You could buy a stock for free and then hold it, sell it for free as well. So all these fees that came with being a stock investor sort of disappeared. And that's the other thing that came in was fractional shares. So you used to have to buy an entire share at a time. So say Apple stock, for example, would trade around $250 for one single share. And you couldn't buy any Apple until you had enough to buy a single share of Apple. You needed $250 to buy one, and then you could get in. Or Amazon was up at around 1,000 for a while. So I remember when I started investing, I was like, oh, this is like totally out of reach. Like, I will never own Amazon stock. When am I ever going to have $1,000 to throw on a single stock? It just doesn't make sense. But then fractional investing came around, which means that you can take any sum of money and buy fractions of those shares. So you can start with $5, $10, $20, $50, $100, whatever you have, you can start. And that's the key thing. You don't have to wait to have a lot of money to get started. You can start with a small amount. So find somewhere in your budget to carve out $5 a month, $10, whatever it is, and start investing that. Start buying index funds or stocks that you're interested in, and let's start seeing, can we get that money to grow, and over time add more to it. So don't wait until you have a lot. Get started as soon as possible. All right, your turn. Do you have another myth that we want to bust?
Yeah, one that I, especially when talking to young people, is that retirement is an age. Like, retirement happens at 65. And I feel like this is even believed among many like adults. And the reality is that no, it doesn't. Like, ever walk into a Walmart and see someone who's 90 years old, pushing carts or acting as the greeter? They don't love that. They're not volunteering. They're doing it because they don't have enough money to eat if they don't work. On the flip side, I retired at 36, which is hopefully younger than most of your parents, or else I'm getting really old. And the reason that I was able to retire is just because I had enough money. And so retirement isn't an age, it's an amount of money. And we can almost quantify this amount of money. That's generally, the commonly accepted number is about 25 times your annual spending. And so if you spend $40,000 per year, for example, like let's say you guys go to college and graduate, and then that ends up being your cost of living, pay for rent or mortgage, car, whatever, costs of $40,000 a year. 40,000 times 25 is $1 million. So if you can get your investments up to $1 million, then that $1 million is growing so fast that you can take 40,000 per year. And even with the short-term volatility of the market and inflation, all the other factors that go on in the economy, you'll never go broke, and you can live off of that forever. And so, we think of retirement as like, okay, when you're old, you stop working, you retire, but you don't get to if you don't have enough money. And if you have enough money sooner, you can stop sooner. And so I really think of retirement as like this race to 25 times your spending. And that race can take as little as like 12 to 15 years. If you, for example, if you get a job out of college that pays like 80 grand and you live on 40 grand and you invest 40 grand, we'll say after taxes for all these numbers, you know, living on 50% of your income will get you there in about 15 years, starting from zero. And so you could retire at, in your, mid late 30s too, if you are aggressively living below your means. It's kind of extreme, but people live on 40,000 a year all the time. So if you're making really good money, like 80, then that's not a crazy thing to do. But most people don't due to like lifestyle inflation, like you mentioned earlier.
Yeah, and again, you all that are teenagers watching this, like you have this blank slate in front of you where you haven't taken on a ton of debt yet. You haven't inflated your lifestyle in any way yet. And you get to decide moving forward, what kind of lifestyle do I want to have? If I make $80,000 a year, can I just make that decision from day one that I will live on 40 and the other 40 will go into investments? And I promise you, you will never even feel like you are making any sort of change or sacrifice, because you're just going to get used to inflating your life up to 40. And that other 40 is always, it's never been there. It's always been in investments. You've never felt it. You've never had it. You've never held it. And you will be shocked at how fast your investments will grow when you're doing something like that. And then just going back to your like really great myth about retirement. Retirement is also not this point where you just stop working altogether. Retirement is a freedom to choose what you do. Like you said, you are retired, but I know you kept throwing your quotation marks up because we always feel like we have to disclaim this, that retirement means you stop. You're not allowed to work anymore. You cannot make another dime because you are retired. And really, retirement is the point where you can choose to take a lower paying job. You can choose to work on your own business or a hobby that happens to make some money. And you have the freedom to choose whatever you want to do. You're not pressured to make money. So you can do whatever you want. If it makes money, great. If it doesn't, who cares? Your investments are covering you at this point. You are retired from having to work. So
Totally.
Make sure you guys all are aware of that is something that you are shooting for here, is that freedom to use your time whatever way you want. If you want to make money with it, great. If you don't, that's totally fine too. All right, my one is I'm too young to start. So I'm under 18. I'm not allowed to invest yet. It's not legal for me to invest until I'm 18. Is that true?
Kind of. I guess all these do have like a piece of truth, which is you cannot go open up your own investment account under 18. That's law. But if you have a parent or a guardian, there are many types of accounts where you guys can, invest basically together with them being a custodian of the account. One, and actually this was the Q&A that's in there right now. One is just called a custodial brokerage account, which is basically, it's a child's, the under 18 persons. I remember being 16, you're not a child, but the young adult under 18 person's account, but then the parent or guardian basically is the custodian of it. But then the day that you turn 18, it's your money and they can't take it from you anymore. They could take money out of their neighbor's account or something like that. And for parents, it's, kind of good and bad. It's good because you get your kid investing early, but also the money just automatically turns over. There are other accounts like 529s, which are meant for saving for college that you can invest in. There's accounts like a Roth IRA, which if you were working, like let's say you have a job as a teenager, you can contribute to a Roth IRA. And a Roth IRA is a special type of account, just like a savings account or a checking account. But when you put money in this account, you can invest it. And then all the future growth is never, ever taxed again. And so it's a great way for young people to get started investing and never pay tax in it. And it is a custodial Roth account too, if you're under 18, but same thing, once you turn 18, it becomes the new adult's account. And so, if you have and not everyone in the sound of our voice, I'm sure has the same situation, but if you have parents who are financially savvy themselves or are open to learning and trustworthy and all that stuff, or guardians, you can have that conversation about opening one of these custodial or joint accounts. If not, saving is a perfectly reasonable thing too. You could save cash, you could, save in a checking or savings account. And then when you turn 18, you could dump that money into investing.
So yeah, to recap, like a custodial account, you have an adult who's on the account with you. If any of you have a bank account right now and you're under 18, it's a custodial account. So you need someone over the age of 18 to help you enter into a legal contract. So they have to be that person who is signing on your behalf. And then the moment you turn 18, they fall off the account. So it's a very special type of account where you don't have to do anything. Just the moment you turn 18, they fall off the account. I think in some states it might actually be 21, if I'm correct. So like there is, you may have to check your state to see, is there a specific age that's not 18 that's in their law? But for most states, it's 18. And you are the owner of the account, you're adults. So I say adult because it does not have to be a parent or guardian. It could actually be any adult you want to sign up with. But they do have co-access to this account. So just be aware of that. It needs to be somebody you do find trustworthy. And I like that you said that. So if you have parents, guardians, siblings who are not particularly good with money, who maybe have not been trustworthy with money in the past, they're not a good idea to open up something like this with, just if you are worried about your money going walking when you're not aware of it. But someone, yeah, who you trust, who will just let you do your thing, this can be a great way to get started. And you mentioned a couple of different types of accounts, and I do want to come back to that in a little bit. So there's a like how to start investing that we will get to in a second, but I do want to come back to those because those are big words that we need to talk about. Let's do one more myth. Let's bust one more myth and then we'll go into Q&A. Do you have one more on your list?
Sure, or you can go with yours.
Go for
It's
it.
yours. I say that it's really complex. I think that when you hear the word investing, it's terrifying. You know, there's like pork belly futures and day trading and options and, you know, Wall Street and guys on the floor frantically waving white pieces of paper over their head. And there's this huge financial services industry that kind of makes it complicated, or makes it seem complicated because they're trying to do things to make money for their own businesses. But in reality, it just takes a couple of clicks of a button. You know, like if you guys have ever used Venmo or you know, these other apps that are like, you know, it's very simple. You can open up, there's equally simple apps for investing. You're like Betterment, I think is one of the better ones, but there's even ones like Acorns where it kind of like rounds, you know, when you spend money on the debit card, it takes all the change and puts into investment account. Like that's investing. And the way that Acorns invests is actually what we talked about, invest in index funds. And so, you know, there's some very easy apps, and then doing it like the real way is only slightly more complicated, where you just go to a website, you click open an account, you type in the investment that you want, and then you're doing it, you know? And so it really isn't this massively complicated process that is not accessible to normal people. It's been made very easy. But it does take, you know, a few hours of learning to just figure out how to orient yourself, which buttons to click, you know, not falling for tricks or whatever. But yeah, I encourage you guys to do that because, you know, if you're in high school, I know I've like a million sympathies for high school students. I coach high school volleyball. I know that you're like trying to get to college and learn to drive and learn to date and have 15 classes and you can't ever get enough sleep. And like some old dude telling you to learn to invest is like so far off your top 10 list, or whatever. But you know, one day you're going to want your money to be working for you because you don't want to be working yourself your whole life. And, you know, take that time to learn because it'll be worth it.
Yeah. And like Jeremy said, like you can make this as complicated as you want. There is the simple path, which is very like a couple of hours and you're good to go. Like you learn how to open an account, you learn how to link it to your bank account, you learn how to make an automatic transfer to it, and then let it just invest in the same investment over and over and over again. So like I have a brokerage account called M1 Finance, which I really love because I just get to tell M1 Finance, when I send money to this account, I want you to divide it into these investments. So it puts into the index funds, maybe some individual stocks, whatever it is, like it will just divide it up. And every time I add money, it just does that. Like there's no thought involved beyond the 30 minutes I spent setting this thing up. So I have an automatic transfer from my bank account into M1 every single month. And I don't do anything else. Like I literally don't touch it at all. It just does it all automatically. I haven't looked at it in a while. And I know that that is just doing its thing in the background exactly the way I want it to do. You can invest in things like target date funds. So these are funds that, you know, I'm going to be retiring or be retired at a certain date. And I want to make sure my investments are preparing me for that date. And you can use companies like Vanguard, Fidelity, Schwab, these reputable companies that will have these target date funds, and you just throw your money in there and you're like, I don't really want to know what's inside of it. I don't care to know. I don't want to know how the car works. I just know that it will get me to where I need to be. And I can make that an automatic thing every single month. Like there is 30 minutes to an hour of learning to make that happen. And if that's the kind of investor you want to be, there is a way to do that. And if you want to be more involved, if you want to be picking investments and really watching things like charts and become a stock trader, like you can certainly do that. It's a more complicated path, but you can make that, if that's your passion, if that's what you want to do, you can make that happen as well. So it does not need to be complex. Myth busted. All right. Kind of hit the one I was thinking of as well, but the last one I want to throw out is that you don't have to wait to start until you've paid off all your debt, until you've gone through college, until you've gotten married. Like, I hear so many people tell me, I'm going to wait until ... life event has happened, and then I'll start investing. And this comes back to the mechanics of how investing is so powerful. But why is it so important, Jeremy, to start now versus in your 30s?
I think that's true for like so many things of life. I think people are always like waiting for the perfect moment to do X, Y, or Z, and then it never comes, and you like miss your chance, whatever. But investing is just math, which is the earlier you start, the dramatically better your outcome is. You know, there's like a famous example where if you invest, you know, any amount of money, let's say like $200 a month from 20 to 30, and then you never invest another penny again. So just for 10 years, you invest $200 a month, and then you just let your investment sit there and grow until you're 65. Or a different person doesn't invest in their 20s and invests in their 30s and their 40s and their 50s and their 60s, invest for the rest of their life. The person who started in their 20s, who invested for only 1 decade instead of 3.5, will end up with more money. And so it's shocking how powerful the early start is. And so, you know, for sure, maybe it's a deeper conversation. Like if you have credit card debt, you should absolutely be attacking that credit card debt before you putting any significant amount of money into investing. But I wouldn't, you know, wait for the perfect moment until you like have all this extra money, because generally money finds its way to get spent. And so you want to prioritize paying yourself first, you know, pay down your debt, invest, and then with what's left after that, then you can spend that money. I think that's a better plan, so that when you do start early, you've got that, you know, amazing power of compound growth over time.
Yeah. And just get started. We've talked already about it does not take much to get started. Even if you have debt that you're paying down, to say you're in high school and you've already got a car payment, or you've opened a credit card and you've got some money sitting on that, we definitely want to get rid of that debt. Like, don't get me wrong, debt is definitely important to get rid of, but we can open the account, we can link it to our bank account, and we can start maybe $5 a month going in there. Just start that little trickle, start that snowball rolling, and keep adding and growing to it as your finances become better and better and better. And it will meet you on the other end with a huge amount of money. So time is your biggest friend. And Jeremy mentioned it's math. For those of you who have gone through an algebra class, this is exponential growth, or exponential growth functions, which hopefully those two concepts were linked at some point, that money grows exponentially. So it grows by a percentage every single year. And it's not exponential in the sense that your money is going to grow by a fixed percentage every year. It's sort of how companies grow over time. And when you include things like dividends coming out, that you will see an exponential pattern to how much your money is worth. But time, guys, time is your best friend. The sooner you start, the less you have to put in to have more later. The later you start, the more you're going to have to put in, and over a faster period of time, so you're going to have to put in more aggressively to try and get to that goal. So start now, start with a little amount, and then add to it as you can. All right. If you have any questions, please drop them into the Q&A section. We'd love to answer those. I know there was one that you referenced already, so we'll tackle that one. What would your recommendation be for a college student who's making about $6,000 a year doing part-time work, and where should they start? So should they do an IRA or a brokerage account? What do you think?
In my opinion, Roth IRA is perfect for that college student. You know, when you're making, so just for some context, this anonymous attendee asked, should they do an IRA, which we often call a traditional IRA, a Roth IRA, or a brokerage account? All three of those are just types of bank accounts. It's like a checking account or a savings account. But these are traditional IRA, Roth IRA, brokerage account. And they're these fancy, crazy sounding terms that are very confusing when you hear them for the first time. But there's normal accounts. You open them by going to a website and clicking open an account, and then you have it. It's got like an account number and you put money in there. But there's different rules for them. And so a brokerage account is almost exactly like a savings account, except you can invest inside of it. So you can like buy index funds, you can buy stocks. But just like a savings account, a brokerage account, you're taxed on the gains and then on the dividends. And you might not even realize you're taxed on your savings account, but you are, or at least you should be. You know, when you get paid interest in your savings account, you have to pay tax on it. It's like income to you, you have to pay tax on. And same with the brokerage account. And so that's a fine option. People have been investing in brokerage accounts for many decades. But there's a better option, which is the Roth IRA. And a Roth IRA, same thing. It's a brokerage account. You put money in, you can buy stocks and index funds, but you're never ever taxed again. And so if you're a young person making only $6,000 per year, your current income tax is low to zero, which means you can put money into a Roth IRA, basically tax-free, and then it's tax-free on all the gains. And so, there's basically no better tax opportunity. And these are all just tax differences. They're all, what goes inside of these accounts is the same thing. You'd be buying index funds in all of them. But with a Roth IRA, you never pay tax in. And traditional IRA, the third one that's mentioned there, is basically, it's also a tax break superior to the brokerage account, but you get the tax break this year. Like, you don't pay tax on any money you put in this year, but then you do pay tax on all the money you take out later. And for a young person making $6,000, that basically makes no sense, because you're already not paying tax this year and you don't want to pay tax later when you're rich. And so, yeah, I'd say absolutely I'd go with the Roth IRA in that situation. In fact, my oldest nephew is 17, applying for college right now, and he just got his first job at a pizza parlor. And this morning, when I was thinking about this high school hour, I was like, I should call Eli and like get him a Roth IRA and put some money. Maybe I can like gift him the money, and he can keep his pizza money. But then, yeah. And one of the rules, by the way, the Roth IRA, well, yeah, I should have said the caveats. One of the rules is you can't put in more than you make. So if you have no income, you can't contribute. If you only make $1,000, you can only put in up to $1,000. You can't put in more than $6,000 per year in 2022. It goes up to $6,500 in 2023. And you also can't take out any of the gains until you're 59 and a half, which sounds like an insanely old age when you're young, but generally the tax break makes it extremely well worth it. And later in life, you'll have money all over the place, and you'll be very glad to have this tax-free money in your Roth IRA. So that's what I would do.
And this actually, one of my students' questions sort of comes in here now on the back of this. Should I make a separate account specifically for investing? And the answer is yes. So Jeremy said it's like a checking account or a savings account, but in a checking and savings account, you cannot own stocks. You can't invest that money. In a brokerage account, an IRA, a 529, these are types of accounts where you are allowed to use your money to own assets, to own stocks or bonds or things like that. And as Jeremy said, it's treated differently from a tax perspective. So in terms of your order of operations, like which one should you do first? Jeremy, what do you think there? Because you did mention like Roth IRAs have some specific rules about like when you can access it and how the money is taxed. But like if you're just getting started, what would you do first?
So I actually have, can I share my screen? Am I allowed to like give visuals here?
You should be able to, but let me double check that you can.
I meant more like, oh no, actually it is disabled. Yeah, maybe if not, I can just say it. It still says disabled. Can you make me like a co-host?
Letting you share? Oh, got it.
Nice. Zoom always. So this little checklist is basically the order of operations for investing in, and this post-it note sized piece of paper here. Once you understand what's saying, which we could talk through a little bit, but it basically has everything you ever need to know for the next 80 years of your life to do optimal investing. And so, this first section here is the accounts. And so you invest in these accounts in this order up to these limits. And so if you're not employed, then you don't have a 401k. A 401k is another special type of account, basically only offered to certain employees of companies. This is just US federal.
You have to do it through your employer. Yep. You cannot sign up for one of these on your own. So you need a job that offers this to you to be able to use it.
Right. And so if you don't have that, you just skip it. And if you do have it, then you invest up to the match. Sometimes employers basically incentivize their employees to invest because it's in the employee's best interest. They say, hey, if you put in 5% of your salary, like let's say you make $50,000 and you put in $2,500, 5%, we'll put in another $2,500. And so they'll double it. They'll like match your contribution, which is what that's called. And so do that first. Second's actually an HSA. That gets a little bit, more obscure, where it's called a health savings account, another type of bank account, depending on your health insurance that you can put money into. But if you don't have that, just skip it. And so for most people, I'd say start with a Roth IRA. And then if you don't have the 401k, you skip it and then go to the brokerage account. And so, yeah, that's just, it's pretty simple as you get older and you've got the different types of health insurance and you have a 401k, then you would work down all 5 steps here. But I'd say, for young people, go to that, just keep hammering that Roth IRA until you've got the max of 6,000 for this year, and then put everything extra into a regular brokerage account.
And I think you have another tab ready to go for the next question that actually just came in, which is it better to do a total stock market index fund or an S&P 500? So an S&P 500 fund is the 500 largest companies in the US. So you can have an index fund of the 500 largest or all the companies in the US. You can do the largest 1,000, but you had a great post that kind of showed like, how do those compare to one another? And would love for you to share that if you have it up.
Yeah, and Kristen almost asked the exact same question right now, which is, why would you choose one over the other? And so the first question says FZROX versus FXAIX. Yeah, they're the same question. S&P 500 versus total market. And so when I talk about historical market returns, I often talk about the S&P 500, which is essentially the 500 biggest companies in the US, and they're all constantly updating that list. And so the smallest one falls off and the newest growing one gets added. And then when you track that growth of the value of those companies and the returns of those companies over time, you get a really nice picture of basically, an approximation of the US economy. But you totally can invest in the S&P 500. Many people do. There's index funds that track just that. But some people invest in the total US stock market. And so the S&P 500 makes up about 500 companies. The total stock market makes up about 4,000. And so when you invest in the S&P 500, you're missing out on 3,500 companies. They're all the small ones. You think of like the biggest ones as like as a line chart. The biggest ones over here, and then the smallest ones are kind of the long tail over here. And as Kristen wisely points out, in terms of market cap, in terms of total value, the S&P 500, despite having a smaller number of companies, makes up about 80% of the value of all the companies because they're so big. And so which one should you do? And so here's the answer on this tab, as you notice. And so here is the 12 most popular US index funds that have been around since 2012. In fact,
and these letters, by the way, are what we call a ticker symbol. So they are just a 1 to 5 letter representation of either a stock or a fund. So like VTSAX is one of the most popular. That is the Vanguard Total Stock Market Index Fund. What are some of these other ones?
FXAIX is the one that our question asker asked, which is a Fidelity 500 index fund. SPY is like the oldest S&P 500 index fund. VTI is the Vanguard version or the ETF version of the Vanguard fund that's got like 3,000. And so all these are different. Like IVV has 500, ITOT has 1,500, VTSX has 4,000. But look how different their performance is, which is virtually identical.
Negligible.
It's negligibly different, and I could not possibly sit here and tell you which one is likely to be a tiny bit better. So when I talk about the S&P 500, it's because of its very easy historical return, or record where you can look back, 100 years and really see how the market has done. But going forward, I have no preference to invest in just those companies. Like my preference is just very, very slight, but is to invest in all the companies. So like, why not buy like your VTSAX? And so it is slightly more diverse, but it just turns out because the S&P 500 makes up 80% of the market and the remaining 20% correlates pretty closely. Like if inflation goes up and rates go up, it's kind of bad for all companies, big and small. And so they usually go up and down in tight correlation. It just turns out that all of these basically perform exactly the same. And so the answer is just buy whatever, my slight preference is to buy the total market. But sometimes I see people who have a 401k and they don't have that option. They have like some worse options that are high fee or a low fee S&P 500. I'd be like, great, go with the S&P 500. If you just like the S&P 500 because Warren Buffett talks about, sure, why not? You're not going to get rich by picking between these two lines. You're going to get rich by investing consistently over time and pouring more money in as time goes on.
Okay, so that's a great answer there. And Josie in my class has a similar question. What should a new investor invest in? If you're not sure, it doesn't really matter between any of those, but like looking for some of those big index funds, so that holds a lot of the US stocks. Do you think there's much of a difference between going international and staying in the US? Like, should we be doing a total world index fund because then we own everything in the world essentially? Or sticking more with the US? Like, how do you feel with that?
Great question. So I love the concept of a three-fund portfolio. Maybe I can make my screen a little bit bigger here because it's getting kind of small. And so what we were just talking about was all US stocks. But as you may be aware, if you are in high school, the US is not the only country in the world. We are economically the biggest country. Our economy makes up about 50 to 60% of the global economy in terms of value, but that still leaves about the other half or so where those companies are headquartered outside the US. And those are companies like Samsung and Alibaba and Nestle and Volkswagen. And, these are companies that we use and are used around the world and are maybe bigger in other countries. And maybe it's the case that the US isn't the global economic superpower over the next 100 years that it was over the previous 100 years. And if so, I don't know, like I can't tell the future, nobody can. But if that is the case, then I would like to be owning some of those other stocks too. And so that's where a three-fund portfolio comes in. And so a three-fund portfolio is made up of a total US stock market index fund, which is the ones we just looked at in that chart, a total non-US stock market index fund, those are those international companies, and then a bond index fund, which we haven't talked about bonds this hour at all, but bonds are another way to invest, buy things that are likely to go up in value, pay you while you own them. It's just another like less aggressive, but more income producing type of investment. And so if I scroll down here and the question is like, what do I invest in? Like you could go by these three ticker symbols. VTI is Vanguard's total stock market ETF. VXUS is Vanguard's total non-US stock market ETF. And BNDW is Vanguard's global bond ETF. And so you could buy those three things, like you could type them into M1 Finance or Robinhood or Fidelity or whatever. If you use something like Betterment or Acorns, it does this for you automatically. So you don't even need to choose these. It basically chooses essentially this for you automatically. Yeah. And then if you want to know how much of each you buy, you look down here, this chart. So if you're, you guys might be under 20, which means you're at the youngest, but you can buy like mostly US stocks, second most non-US stocks, and then the smallest amount of bonds. And then you can see as you age, your bonds go up. So if you're an old person, then you have lots of bonds because those just produce income and let you live off your investments. But this stuff is like the more aggressive, faster growing, more volatile stuff that you want when you're younger.
And like in a very small nutshell, a bond is a loan. So you are loaning your money to either the US government, so you can do it to your state, so municipality bond, or a corporate bond, you're loaning it to a company. And the bonds either have high risk, so the company or the state or the country has a high probability of not paying it back, so you have a risk of not getting your money back, to very low risk stuff like a US Treasury bond, where basically you're saying the US government is very, very, very likely to pay you back. So it's not going to give you as high a return on your money. If you want to learn more about bonds, we'll probably have a bonds video coming up soon, but certainly ask in your personal finance class, look it up on YouTube. There are lots of great places to learn about these things. I wish we had time to go into it today, but we definitely do not. All right, so what about a cryptocurrency index fund? So I don't know which cryptocurrency is going to be the next one. I don't know if it's Bitcoin, I don't know if it's Ethereum, I don't know if it's Dogecoin, but what if I do the same approach? What if I just say, I'm going to buy an index fund that owns all of them? Does such a thing exist? And is it a good idea, bad idea?
So in my opinion, crypto is not investing, it's speculating. Crypto does not pay you while you own it. And then, there's like kind of gimmicky ways like staking that maybe crypto enthusiasts will say is, but basically when you buy a stock or you buy an index fund, you're legally a part owner of those companies. And there's like massive amounts of banks and case law and tradition and precedent that says as those companies go up in value, you're due a piece of their profits. They're backed by real physical growth and sales and goods. And so when you invest in an index fund, you are basically getting this real concrete thing of value. When you invest in any crypto, you're just hoping someone pays you more for it later. And there's none of that inherent value. And the arguments for crypto are like, well, it's a currency. I'm like, fine, but I'm also not investing in currencies. I don't invest in the euro or the yen or the peso for the same reason, because it's just speculating. Some people do. I call it speculating, but there's this thing called like foreign exchange trading, where you're trying to trade between different foreign exchanges, but it's just gambling. It's just speculating. And by the same token, crypto is. So here's one dude worth $4.5 million, and I do own like, $2,000 worth of crypto or something, like a, relative to my portfolio, it's like dramatically less than 1%. And so if you have $100, maybe like 2 cents of your $100 should be in crypto, and 98 or 98 should be in, an index fund. And so that's my take on crypto, just generally. That said, like I like the idea of a crypto index fund if you're going to. I don't think it exists. There's been a few crypto ETFs that are like really high fee. It's just a messy space right now. It's not regulated. I don't have a good way to tell you to trade crypto. I mean, like FTX, like the second or third biggest exchange in the world, just became absolutely fraudulent and stole or lost all the money, and the dude's going to prison for the rest of his life or whatever it is. I can't even with good conscience like utter something from my lips for fear of it not existing in 2 weeks. You could have your own crypto wallet where you just store it yourself, but like that's not without its risk too, because if you could lose it or it could get hacked or whatever, and so it's crazy speculative, crazy. It's not investing. It's not a great way to make money. If you want to gamble a little bit, fine, but keep it small, keep it, way under 10% is what I would do.
And there is a little bit of this with stocks too. So like we look at more recent things like the GameStop and AMC news stories that popped up. And if you're not familiar with those, essentially what happened was you had two stocks, GameStop and AMC, that saw their value or their price dramatically increase in a very short period of time. So with individual companies like cryptocurrency, there is this, like, if everyone thinks it's worth something, then it's worth something. And if it's not worth something. But as Jeremy said, like a company at its core, at least if you're a part owner of a company, that company has value. A cryptocurrency, on the other hand, like the individual coin, it's a digital thing that you can't physically hold. Its value is solely based on what other people think it's worth and whether they would accept it as a tradable item or not. Same with any other currency. Like it doesn't have this, like what we talked about before, the millions of people working really hard to make sure that's worth more tomorrow than it is today. So there is some similarities between the two, and I can certainly understand why some people aren't investing in quotation marks in these things. But as Jeremy said, it's a higher risk thing. It's more speculative, which means it shouldn't make up a large part of your portfolio. And what I liked that you said was, if you want to try some of these things out, like you want to buy individual stocks, you want to buy cryptocurrency or something that's a little bit different, make it a very, very, very small part of your portfolio and make the majority of it something like big index funds where you're like, okay, I know that there is a track record behind this. I know that there is insurance behind it if something fraudulent ever did end up happening. So say Robinhood went out of business, your stocks are still insured in some way. Like you will get yours back, or some other company will take it over and you'll still own those shares because you are an owner of a share. It's not the company itself. So just be careful with that. It certainly can be done if you want to try something a little bit more risky, but just a small part of your portfolio. Oh, excuse me, everyone. Jeremy, what is your number one piece of advice for students who are looking to build their personal finance?
We talked about a lot. It can get very overwhelming. All the terminology, the different types of accounts, the expense ratios, ETF, index fund, ticker symbol, yada, yada, yada. The thing that when I'm like writing in my posts or videos, the thing that I end every single post with is 2 rules to building wealth. Because it's really this simple at the end of the day. Rule number 1 is to live below your means. And I know you started with this and we're kind of nearing the end here, I think, but I'll end with it too. If you make $500,000 a year, like you see these rappers or sports stars, whatever, making tons of money, but you spend $500,000 a year, at the end of the year, you're broke. You have 0. You're just a broke person. Whereas if you make like $40,000 a year and you spend $30,000 a year, you've saved $10,000. And saving and investing $10,000 over the course of a career will easily make you a multi-millionaire. And so rule number 1, no matter what, is spend less than you make. And rule number 2 is invest early and often. And so if you spend less than you make and you take what you didn't spend and you just invest it regularly, even if you're making mistakes, even if you pick the wrong ticker symbol, even if you do some stupid stuff with day trading or whatever, but if you're consistently investing and buying and holding and letting that grow for years, you're going to be rich. You're going to be dramatically better off. And so I think that a lot of people can, let perfect be the enemy of good. They're like, oh, I'm afraid to start because I don't want to mess it up. Or it's intimidating or they don't know what to do. And at the end of the day, you just have to spend less than you make and invest the difference. And doing those two things consistently over time is how you get rich.
That's a wonderful piece of advice to finish on. I saw some questions popping up about what was the three fund portfolio that you talked about. I will have all of those linked in the description on the YouTube video for this replay. If you want to check it out, I will also send it out in the email for anyone who registered. But Jeremy, thank you so much for your time today and for all this wonderful advice. How can people, I guess, contact you, follow you? Where can they find you?
Yeah, my online personal education or finance education brand is called Personal Finance Club, personalfinanceclub.com. Most of the magic happens on Instagram at Personal Finance Club. We got TikTok, we got a YouTube, so you can like and subscribe. I'm a pretty easy dude to find on the internet.
All right, so you heard it there at Personal Finance Club. Jeremy, I'll see you there. Thank you so much for your time today, and we'll see you soon.
Thank you, Rob. Thanks for having me.
Bye.